All right. Matt, the mortgage guy here, live and direct. Mortgage Q&A every Monday, 6 p.m. Pacific Standard Time, even on holidays like today. Today we've got a Labor Day special, right? So it's a holiday, but I'm here in the office because I enjoy talking to folks, educating them on mortgage, home ownership, the real estate market, and all that stuff. So we'll jump into any and all questions you have. Every week there's new stuff. There's stuff that, I can't predict because, it's just off the cuff and it's, true Q&A, anything goes, ask whatever you'd like. I'm going to give you my honest opinion. And, before we jump into it, the regular flow has been, I will answer any questions I couldn't get to, last week or didn't have an immediate answer for you. I will tell you that my digital notepad was in my car and it's 100 degrees in Sacramento. The digital notepad is black. It's not turning on. So don't have last week's stuff to open up. But until we get more people kind of joining and asking questions, if you're on now, feel free to just fire away in the comment section who you are, where you're from, what questions you have, whatever comes to your mind. One thing, a topic that's on my mind, because I just recorded a video on it, is buying a house and renting a house. Two options you have. You don't have an option to not have a roof on your head. I'm sorry. You do. Not a good option, and I don't wish that on anybody. But in general, people need a place to live. So they need to choose one of two things. They're going to rent or they're going to buy. And I think a lot of times folks don't necessarily understand the short-term and long-term pros and cons of buying versus renting. Whenever I say anything about buy versus rent, I can tell you with absolute certainty that I'm going to get people. They're like, oh my gosh, you're a mortgage broker. You think everybody should buy. You're going to be super biased. You're just going to say, there's all these benefits of home ownership. And if you're not buying a house, you're an idiot. Throwing money at rent is like lighting money on fire, yada, yada. I've heard it all, right? What I really want to do, though, is look at buying versus renting, and not even buying versus renting, but just look at statistics for the two. You'll see tomorrow, Tuesday the 7th at 2 p.m., the video will come out. The video I just recorded today that has some stats, and stats don't lie. When you talk about renters paying 31% of their income towards their rent, and then you compare that to buyers who have, differing front-end ratios or mortgage payment versus their income, averaged, it's lower. People are paying less of their income towards a mortgage payment than they are towards a rental payment. Sure, you got to come up with a down payment, and there's different programs that can allow you to do that with 0%, 3%, 3.5%. But a lot of misconceptions. And I think one of the biggest things I talked about in my video that comes out tomorrow is the perception of affordability. There's 108 million Americans that live in rentals, like 44 million households that are renters. And it's because they perceive it to be more affordable. When you look at the numbers, or if you, start to look at long-term, what happens to rents over time, like 40 to 50% increase every 10 years, then it starts to look like the long-term play is clearly buying. And, debt pay down, tax benefits, appreciation, all that stuff. I mean, it's stuff that I've said, and it's stuff that, may or may not be come across from somebody who's in the business of mortgage as I'm looking out for folks, but it's just so clear that I want to help people understand it. I want to help people get to the point where it's their time to buy and they're able to buy a house. Not that this month, this year is not everyone's time, right? Maybe it's next year, maybe it's 2023, but long-term home ownership is awesome. It beats out renting on so many different levels. So anyway, let me know what you think of that video when it comes out tomorrow. Let me know what you think of some of the stuff I brought up in there. If there's anything I missed, if there's anything you want to discuss, Interesting topic. And especially right now, so much is being talked about. Home price increases and year over year appreciation of this much in this market and that market, and Boise, Idaho, and San Diego, California, and Phoenix, Arizona. Homes are becoming unaffordable, and this and that and other. What about rentals? Why don't people talk about 15% year over year rent increases in some markets, and what rent prices have done, how hard it is to find a rental, all the demand, the little supply on the rental side? It's just as tough, right? So if you've got two different things that are equally as tough, but one has a ton of long-term benefits, you might want to do tough thing one over tough thing two. My 2 cents, right? All right, let's get into some questions. I appreciate everyone joining me on this glorious Labor Day. Jorge Guzman, bunch of diamonds. I think this is good stuff. Hey, Evan, let's go. Hello from Michigan. Was wondering what the minimum mortgage score to get conventional. This is a great question. And to get a conventional loan where the automated system is going to give you an approve eligible, which a lot of stuff like the first filter is the automated underwriting systems that Fannie Mae and Freddie Mac have in place. 620. Small caveat, because it's actually something that's happening and changing right now. They have tweaked their algorithms to where very soon you're going to be able to, instead of taking the lower of the two middle scores when you've got multiple borrowers on a loan. And a quick example for anybody who doesn't understand how that works. If you've got borrower A who's got a 580, a 590, and a 600 score, Experian, Equifax, and TransUnion, their middle score is 590. And you've got borrower B that's got 670, 680, and 690. That's their three scores. 680 is their middle score. We're going to take the lower of the two middle scores to qualify. And in our example that we just gave, 590 doesn't meet the 620 requirement to get an approval through the automated system. What Fannie Mae and Freddie Mac have said is they're going to allow an average of those two scores. They'll take 590 and 680. Is that 90 apart? What is that? 635. I think 635 is the average of those two. The automated system can now say approve eligible because it's above 620. It wouldn't read it in the past. If it was below 620, it would just say, no, not taking it. So to avoid what is called a manual underwrite, where we don't use the automated system and underwriters have to look at it manually, I'm going to skip that. We'll see how it plays out. We'll see if that helps more people with multiple borrowers where somebody's got some challenge credit get approved. But the quicker answer to your question, Evan, is 620 to go conventional. And depending on what you're doing, if you fall between 620 and 640, or even 620 and 660, up to 680, 620 to 680 to look at FHA versus conventional. That's what I'll say. Depending on down payment, depending on some other factors, it's not black and white. Like you got to go FHA at 625 and you got to go conventional at 685. Not that, but what I'll say is between 620 and 680, make sure to compare, because it's going to be a side-by-side comparison, and any good loan originator is going to be able to clearly explain to you why they think one is better than the other. And you'll clearly be able to see it, where you're like, holy crap, the mortgage insurance is double and the interest rate's 1 point higher on conventional. I'm definitely doing FHA. Or mortgage insurance is cheaper. There's no upfront MI. Conventional is much better on this scenario, right? And like I said, depending on down payment, depending on credit score, you'll be able to figure that out. Kevin Hawthorne from Florida. Good to see you, buddy. I think I got one of your Labor Day emails today, so I'm on one of your lists. Keep up the good work, my man. Appreciate you being here. All right. Currently under contract. See, guys, people get offers accepted. Inspections all done. How soon does the appraisal get done after this? When you first entered into contract, Sarah, your loan officer, in most cases, is sending you initial disclosures. You're signing those like an e-sign, with all the numbers and whatnot. And then they're going to send you a link to pay for an appraisal, or say, oh, we're ready to pay. We're ready to order the appraisal. Fill out this form with your credit card information and authorize up to $600 or whatever that is, right? That should be happening fairly soon from the very start of the process, right? Yay, congrats, we're in contract. And as an example, the stuff that went into contract over the weekend, we're going to get title information. We're going to get the contract from the agent come tomorrow morning when lenders are open and title companies are open. We're going to order title fees. We're going to send out disclosures. Once the buyer signs those disclosures, we're going to order the appraisal and send you the link to pay for the appraisal. So that's going to happen right away, depending on where you're at and how quick appraisals are getting done. Here in California, it's probably a week out from getting performed, the actual appraisal inspection, and 10 to 12 days from getting the report back to us. So you'll pay for it within the first couple days of going into contract. They will contact the listing agent to schedule that appointment. They'll do it, sometime in the next week to 10 days, and then get that report back to you first. You paid for it, so you're going to get a copy. But they'll send you and the lender a copy at the same time. Here's the report. Came in at 385 as is, no repairs needed. Whatever that report says, it's going to come to you the same time it comes to the lender, because you're the one paying for it. It's your appraisal, but also the lender needs it to approve a loan for you. So hopefully that helps. Let me know if there's any other questions you have. Happy to help. Congrats on getting into contract. Now the fun begins. I know it can be kind of a stressful process, but as long as you're using a good agent and a good loan officer, it should be a time of, excitement, because, all the paperwork is just collecting this, collecting that, sending this. To me, the hard part's done. Getting an offer accepted, finding a house that fits your criteria that you're happy with, that you offered on, got the seller to accept. That's the hard part. Now the easy part's just getting the thing to the finish line. With good folks, should be a piece of cake. Basilio, buenas noches, ¿cómo estás? Thanks for being here. My buddy Emmett Dempsey, what's up, my man? Good to see you. Anybody who wants to just fill their brain with mortgage knowledge and my channel's not enough for you, go check out Emmett Dempsey. He's got some good mortgage info over on his channel. He's pumping out fresh content every week. And so I think you can't get enough. As a consumer, I think, especially folks that are thinking about buying or doing anything with purchase, refinance, anything in the mortgage space, spend those, 5 or 6 hours a week in dead time where you can just scroll through and watch any YouTube video. And, you can scroll Facebook and see what your, long lost friends and people that you friended that you don't even remember are up to. Spend that time doing a little mortgage research. Check out Emmett's channel, watch as much Math and Mortgage Guy content as you can, and, educate yourself so that when the time comes, you'll be prepared. Theo B, what's up, man? If you like it, lock it. Have I trademarked it? I have not. You're giving people ideas, man. I should. Let me write down that note. Man, my digital notepad is dead. I can't believe it. Let me see. This remarkable notepad is like the coolest thing invented, because you just have this digital pen, you take notes, and it's black. Oh, there it goes. It's starting. Okay, it cooled down. I'm going to put your note in here, Theo. If you like it, lock it. I might contact him, and it's already, in the process of getting trademarked because my buddy Emmett got to it first. I got questions today. Okay. How long does lending factor HELOCs when doing a cash out refi? Can you keep your HELOC with the first lender, but refi with another lender? This is a great question, Theo. You've always got good questions, dude. So in your hypothetical scenario, you've got a house that's worth $500,000. You owe $200,000 on the first, and you've got a home equity line of credit for $100,000, whether or not you've actually drawn that money or not, in the lender's eyes, it doesn't matter. You still have $100,000 credit line, and so it's $300,000 in combined loan to value. Your combined loan to value is 60% of the $500,000 that it's worth. $200,000 first, $100,000 second is $300,000 total, and 300 is 60% of 500. And so, with that in mind, when you do a cash out refinance, let's say you want to take 100,000 out and have a new first loan of 300, you can, and your new combined loan to value is going to be 80%, right? Because now you have a $300,000 first and a $100,000 HELOC. As long as you can fit in those combined loan to value buckets where you're not going over the lender's limits, which is usually 80% on a primary home, then you're fine. And it's not necessarily with every. Can you keep your HELOC with the first, but refi with another lender? Right. So you could keep it open in that scenario where your combined loan to value. And I'll say that it's not necessarily going to be the case with every lender. Some lenders are going to make you close the HELOC. Some are going to allow you to keep it open as long as the combined loan to value is within their range. So hopefully that helps. I got to it, Jorge. I just had to give a long-winded explanation, but thanks for answering that. 620 mid score is the minimum for conventional financing, and we'll see how it works with this new, combined or average of the two borrowers, which is like mid-September update, I think, is when that's happening. Not implemented yet. Lindsay, hello. Thanks for joining. Appreciate you being here. Hello from Los Angeles. I'm looking to purchase another primary. I want to rent out my current. If housing is in Los Angeles is now averaging $750, how can I buy another? Well, it's all math, regardless of what you're doing with mortgage financing, whether it's a primary home, an investment property, a second home. It's all just math. So they're going to look at your income, add some departing residence rental income, which my guess is that you're, you said it, rent out my current. So your income plus the rental income that you're going to get from the house that you're leaving on one side, and then on the other side, current mortgage plus that new mortgage plus any other debts. And it's just going to be a debt to income ratio thing on how much you qualify for. And then that next house that you're buying, 5% down on something that costs $700,000, it's going to be $35,000 plus closing costs. You're going to have some money out of pocket for the down payment, but it's possible. So how can I buy another? Good income, good credit, and a down payment. During cash out refi, do brokers provide? Yeah, if you ask for it. A lot of times when you're doing a cash out refinance, not just brokers who are brokering the loans, but the lenders that we're sending them to have a rate sheet where it steers you to that par rate more often than not. And so let's say you're doing a cash out refinance and 2.875 is 0 points. The broker might say, okay, I can do a cash out for you, Theo, and 2.875 is 0 points. They're always going to have the option. Pay 3/4 of a point to go to 2.75. Pay 1.5 points to go to 2.625. Pay 2.25 points to go to 2.5. And it's not like it's the same cost for every 0.1% different, but it's always there. Where you might not have folks pitching you or showing you the whole rate sheet is when they look at it and they go, this makes no sense, right? I'm not necessarily always going to muddy the water by being like, yeah, I can get you 2.5. It's going to cost you $14,900. When I know in my head, I wouldn't let somebody do that. Where it doesn't make financial sense to buy the rate down. But the rate sheet's always there. And when it's appropriate, or when somebody asks, like, hey, can I look at that? I'm thinking about buying the rate down. I'm going to stay in this house for 20 plus years. I just know it, so I don't mind spending a little money up front. Or, in some more rare cases, people actually want to go higher in rate and get a credit back. So certainly available, right? And the only good answer to like, why do they just give you one rate? They just assume that that's the best rate for your specific scenario. Zeta, how's it going? Happy Labor Day to you. Yeah, I take some days off. I actually, this year, have done more family vacations than any other year I can think of. So, a lot of great family time Saturday and Sunday. I don't want anyone to think that I'm neglecting my beautiful family, because we got in all kinds of fun. Friday night, Saturday, Sunday, plenty of good times with the boys. Date night with the wife last night. Cornhole tournament with the wifey and the kids yesterday. So anyhow, yes, days off, just not today. It just feels right to work on Labor Day. Labor means work. So let's be grateful for the fact that we're able to work and get it done. Yeah, I had some stuff I had to do in the office today and a few appointments. So I just I figured let's keep the YouTube every Monday at 6 p.m. streak alive. I know on some days I'll have to change the time, but as long as it's not, interfering, I'm going to be here Monday at 6 p.m. I appreciate those of you who join as well. All right. Theo B, can you finance a loan with two people, but only one person on title, not spouses, no partnership formed? If they're on the loan, they're going to be on title. I'm fairly certain of that. I'm not a title expert, I got a lot of things I'm good at. I'll let the team handle some of that. Let me write this one down. You got all the best questions, Theo. You got to make sure you join every Monday because you got the best questions. Okay, YouTube Live. I'm taking out my notepad. I found it. It's back alive. What was last week? 8:30. All right. 9/6. New notebook. And I'm going to put down Theo's question so I can get back to it next week. Confirming. I know the answer to this. Why am I even confirming this? 2 on loan, 1 on title. See, sometimes I doubt myself. I'll confirm it though. Never hurts to double check. What do they say in construction? Measure twice, cut once. Yeah, get it done as soon as possible. With the appraisals. Yeah, appraisals everywhere are slammed. And it's because there's just not enough appraisers. It's hard to get an appraisal license. It takes all kinds of you got to be an apprentice for a certain amount of time and have like more than 1,000 hours under another appraiser before you can go out there and do appraisals on your own. So yeah, I'm not sure if Sarah said where she bought or where she's under contract, but a lot of states appraisals are taking a long time. So sooner the better on getting that thing ordered, paid for, and rolling. And depending on how long of a contract you have written, Sarah, you might want to think about paying for a rush. I know I've got a broker friend in Nevada that literally just pays a rush fee on every single appraisal, and all their purchases, they just tell their clients, we're going to pay $1,000 and we're going to get a rush and try to get it back to us as soon as possible. We don't don't want it to delay the biggest transaction of your life. And they happen to, have clients that are like, okay, cool. Like they want to get it done. And so they don't mind paying the rush fee. All right, Theo, can you do multiple refis at the same time? The answer is yes. It's advised actually, because when you're collecting 2 months of bank statements and the latest 30 days of pay stubs and mortgage statements for multiple mortgages, all the stuff that you have to collect, it's easier to do that all once on multiple properties than to do it and then 2 months later be like, hey, let's do it again. And we can use some same stuff, 19 and 20 W-2s, but now it's like, all right, we need a new 30 days pay stub. We need new bank statements for reserves and all that stuff. So yeah, do them all at once. I've had plenty of 4-packs and 5-packs where I'm doing 4 or 5 loans for the same person at the same time and getting them all done at the same time. All right. So Lindsay buying in Southern California in Los Angeles. Property I'm interested in is $750,000. I make $100,000. My current home is $360,000. Depending on your current mortgage, depending on your down payment, is going to be tight. $8,000 a month is going to be on the income side, and then you're going to be able to add 75% of what your house would rent for when you move out. So let's say it would rent for $3,000. You're going to be able to use $2,250. And so you've got $8,000 income-ish, $2,250, $10,250. You're going to want your current mortgage and your new mortgage to be less than probably $4,200 to $4,500 and very little other debt. The current mortgage is going to have to be small and the down payment's going to have to be large. It's going to be tight, Lindsay. Have you come across a channel called Reventure Consulting yet? I think you might have sent me a link. I don't know if I checked them out yet. Reventure Consulting. Let me know what they talk about, Liberty. I feel like I've heard that name, so maybe I've watched a video or two of theirs, but not super familiar. Jason Hibbert, how's it going, my man? Can you count unemployment pay as income when trying to refi or buy a home? The answer is a clear no. And the reason is because it's not something that the lender is going to depend on in the future going forward, right? I understand a lot of people collected unemployment, businesses were shut down, people were unable to work. But the lender wants to know, what the person expects to make in the future. And for a lot of people, it's like, hey, I worked for 3 months and then I was out of work for these 6 months, but I collected unemployment and then I'm back to work. The unemployment income cannot use as income. And so where people are really getting stuck and where this really hurts, and unfortunately there's no good answer for it, is people who have variable pay, hourly or some sort of pay where it's like 1 week I make $1,000, the next week I make $775, and the week after that I made $1,240. If it varies, only way lenders know how to predict what you're going to make in the future is to take an average, and it's hard to take an average when there's chunks missing, right? i.e. unemployment. So yeah, unfortunately that's the case for some people right now. All right, Eddie, can you use border income from a renter as income for mortgage on a new property? The only way you can do this, there's a guideline that's written, is if you have a history of taking border income, which like next to nobody has, right? Like in your last housing situation, you were getting $350 a month in rent from somebody who was renting a room, and they were paying you The guideline is something along those lines where it's like, I see it written, but then I'm like, there's nobody that has 12-month history of collecting border income. Or if somebody's like owned a house and had somebody renting a room at their house and was paying $600 a month and then was trying to buy another house, they say, hey, look, I've got this border income. So I guess it's not impossible. It's just not very likely. Like you couldn't just say, oh yeah, my cousin Joe is moving and he's going to pay $600 a month and use that to qualify. Unfortunately, you can't. All right. Here's something, a little bit of something for everybody who's out there looking by, thinking it's hard or impossible. Sarah Corona is a real life case of gotten pre-approved, updated the pre-approval for another 90 days. And a few days after that, found a house and bam, offer accepted. Still hope out there for all you buyers. And I'd like to think it's getting easier in my market in Northern California. It's still bonkers. It's still hard. People are still offering 50,000 above ask and it doesn't even work some of the time. So, so I understand it's hard for a lot of people and every market is different, but slowly but surely some inventories coming to market in a lot of different markets. And I think that, yeah, there's hope out there for buyers. That's the message that Sarah's sharing. And I appreciate the heck out of you sharing that, Sarah, because I've got dozens upon dozens of frustrated buyers, exhausted buyers who have thrown in the towel. And I'd like to think that some of them are going to come back with renewed energy, whether it's later this fall or winter or early next year, and get themselves into housing. Because like I talked about in the very beginning of this, and 2 p.m. tomorrow, I've got the video coming out. The alternative, which is renting, is not a good alternative. When you think about the fact that like a $2,000 rent today is going to be $2,800 to $3,000 10 years from now. It sounds crazy, right? Like you're renting for $2,000, that same place is going to rent for $3,000 10 years from now. But that's like the historical data, 40 to 50% increases every decade. And the stuff we've seen lately, where some markets are seeing 10, 12, and 15% year over year, that number seems low, that over a decade it's going to go up 40 or 50%. But that's just being conservative and looking at historical data. One of the things I looked at said 41%. One of them said 50. I'm just going to say that it's probably 40 to 50% when you look at a 10-year span on rentals. So even if buying is hard, if you're in a position to do so and you can afford it and you've got your finances in order and you're qualified, I think you're going to feel good about buying a house. Mercury News reported that 45% of renters regret renting. And probably for the reasons we're talking about. Rents continue to go up. And, you know, although home prices have gone up and that frustrates some people, once you get into a house, you know, the amount that your mortgage is going to increase, the only variable that changes is little small incremental property tax or homeowners insurance increases, where maybe my payment goes up by $20, you know, 3 years from now, or $40 5 years from now. But I'm sure as heck not going to see my mortgage payment go from $2,000 to $3,000 in 10 years, like some of these renters. So anyhow, there's still hope. And I hope that people take that and they find a little bit of inspiration in it and go out and get themselves into a place. Okay. Your opinion on due on sale clause, please. Due on sale clause, as in, why am I having a brain fart on due on sale clause? My brain keeps trying to go back to when a lender can call your loan due, like all at once. Is that what we're talking about? Due on sale, where like you transfer the property into LLC and they're like trying to get you to pay it. Clarify with me, because I'm not as dumb as I look, but sometimes can act like it. So I don't think due on sale clause. All right, let me talk to my friend freaking Google. Due on sale clause. Okay. Yeah, that's what I was thinking. It never, ever, 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 ever comes into play like people think it will when you're transferring it to an LLC. You can't transfer title to another person, but I've never seen a lender like actually execute this and be like, all right, pay us. So it doesn't come up as often as the question about it. Okay. Yeah. See, I see your follow up too, like warranty deed, primary residence to LLC. I promise you, I've personally transferred property into an LLC dozens of times without the least bit of worry on the lender calling it due on sale. Probably know 1,000 investors that have done it 50,000 times. Never, ever, ever had a lender call for the note to be paid in full, due on sale. So I wouldn't sweat it. Simon Fung, closing in 3 weeks. What should I get my realtor and loan officer as a token of appreciation? Well, just you thinking about them is very kind. I think that the biggest token appreciation is some good reviews and some referrals. If they did a great job and you appreciate the fact that they did a great job, then scream their names from the rooftops, because that's what most people who are growing either a real estate business or a mortgage business are looking for, right? They're trying to grow their business and they want word of mouth referrals above anything else. I would rather have my cousin told me you were great, and we're looking to get refinanced, or we're looking to purchase a house. That means a ton to me, and it's always super cool to have people that we've worked with in the past refer friends, family, coworkers, and whatnot. But if you want to get them a gift, I guess you could think of something that's like related to their field. And if it's a real estate agent, what could you get a real estate agent they could use? Something that they could use for, like a planner or something while they're out there in the field, or get a mortgage person like a really cool calculator. I don't know. I can't think of any gifts, but I think the fact that you're thinking about them is awesome. No matter what you get them, is cool. I've had clients cook me like an authentic dish from, whatever nationality, whatever background they're from, which I always love and appreciate, because that's the greatest thing about California is the diversity. I've had clients send me homemade brownies and cookies, and I got some chocolate dipped strawberries. I got some cupcakes. Man, my clients all want me to have trouble running this marathon in December. They keep sending me sweets. Anything you do will be appreciated, man. Congrats on closing in 3 weeks. For the self-employed, can you write back in accelerated vehicle depreciation as income when underwriting a loan? Depending on what type of business you're in, we can add back depreciation for sure. So you take your bottom line income, you'll add back depreciation and a couple other line items, which I honestly don't even have in front of me. I'm thankfully, thank the stars above, I've worked my way out of grinding through self-employed income calculations to where I would have to pull up the sheet to see like what lines we add back, but I know for sure depreciation is one of them we can add back. And so the answer to your question is yes. All right, Jason, I'm confused. I always thought your rate was based on how you manage your money, but now I'm understanding you can buy points to buy a better rate. Sure. Right. And so here's how it works, Jason. And you know what? Let's do this. Let me see if I can. I'm going to pull up an incognito window because maybe. Wow. What is this? All right. I'm going to pull up a rate sheet, Jason, because I've shared this on others' videos, but it's always fun. I like to show people underneath the hood because as a consumer, you should know exactly what a rate sheet looks like because everybody YouTube test. Everybody who gets a mortgage has options. Here's the thing, Jason. The 2.75% interest rate for you with an 800 credit score is a lot less expensive than somebody who's got a 690 credit score who wants that same 2.75 rate. So the answer is yes. Your rate is based on how you manage your money, your credit score, your down payment, and all that. But anybody at any credit score can buy points to lower the interest rate. So prime example, and we'll pull it up. We'll just say you're buying something for 500,000. Again, apologies for people in Ohio who think that 500,000 is ridiculous. All right, you're going to put down 25% because you've been saving and you don't want a big mortgage payment. So you put 25% down. All right. So let's do this. Control. Oh, shoot. I'm trying to zoom in because I know it's tough to see. Whoops. All right, here we go. Share screen. So this is you, Jason. You're putting 25% down on this purchase. And I don't know how well people can see that, but 2.834 is 0 points. This is the price in this column. There's the interest rate on this column, price right here, and then principal and interest payment right here. So 2.834, 0 points, 1547 is the principal interest payment. If you wanted to pay a little bit more than a point to go down to 2.625, you could, and you've got a 1506 principal and interest payment. Now, for this loan size, you're saving $41 a month and you're paying $4,300 up front. I'm never going to tell you to have a 100-month break even on the point that you're spending up front, but it's available. I mean, up to 2% is available. 5.2 points, pay $19,000 up front to have a 2% interest rate. It's like ridiculously not smart because it's only $160 in savings right there from there to there. So save $160 and pay $19,000 for it. You know, that's like over a 10-year break even. Would not recommend that to anybody under any circumstances, but it's available, right? And then you can go down the other way. You can get a 2.99 and get 2,400 in credit, which, down here at the bottom of the rate sheet on a purchase, especially like this might be more likely for somebody who's like tight on closing funds, right? Take a slightly higher rate, get a credit. But this is how it works, Jason. And let me see if I can zoom in. Oh yeah, see, zoom in a little bit more. Maybe even one more zoom. Oh, that was too many zooms. So yeah, this is par interest rate, and then you pay a third of a point to go to 2.75, a point to go to 2.625, 2 points to go to 2.5. And it's like the law of diminishing returns. This rate right here is usually going to be probably the best looking rate. And this changes how much it costs to buy down points. This can vary from day to day. So it doesn't necessarily mean like today it doesn't make sense. 3 months from now, it's not going to make sense. Maybe 3 months from now, you can go 0.25% better and it's only 0.5 point based on the lenders and how things are shaken out on the back end, right? So anyhow, that's how it works. This is the rate sheet for this specific scenario, 25% down and great credit. If I've got 690 credit, and you know what? Let me do this. I'll show you, because you're like, oh, I thought it was based on how you manage your finances. It is, because 690 credit, this rate sheet's going to look a lot different. I promise you that. Yeah. Now we're 3.1 with no points, right? So the rate got, what's that? Like 0.25% worse at 690 credit score. Still really good because you're putting 25% down, but that's how it works. Based on your credit score, the rate sheet's going to change. The last one, we got to 2.75. It only cost a point. Now it costs 1.5. Which this discrepancy would be more if this was 5 or 10% down, but it's 25. So they're not sweating this guy as much on a 690 score. So hopefully that was helpful. All right, stop sharing. Back to business. Good question. Hopefully that helps you and helps some other folks. Theo, I feel you, man, but you got to get your education. Kind of master's program you're taking? I'm guessing it's canceled today. That's why you're on. So thanks for being here, man. Sorry that class conflicts with this class. You'll have to decide which one's more important. If I file bankruptcy and keep my house, you still get credit for a home. You will, and for the purposes of future credit, obviously the bankruptcy is going to hurt your credit, but then after time, you're just going to have to work on polishing it back up, which is totally possible. I work with people all the time that, bankruptcy, foreclosure, short sale, the works, get your finances in order, pay everything on time. Your credit will improve and recover faster than most people think. So best of luck to you. DTI ratio on a 1099 loan program. What about a 1-year self-employed conventional? Don't know what you mean by a 1099 loan program, but if you're self-employed and you've been self-employed for more than 5 years, we can use 1 year of tax returns. And on a conventional DTI ratio, you probably want to be 36 front end and 45% back end. It's going to depend. It's going to depend on your credit score. Going to depend on your credit profile and all that stuff, because the automated system reads it all. So if you're squeaky clean, you're probably good to 45%. If you got a little hair on your credit on your file, then it might have to be lower. Wednesday, thanks for joining us. On Monday, just moved from New Jersey to Georgia. New Jersey, there's no such thing as small taxes. Mine were going up $150 a year. Holy guacamole. Well, holy guacamole, but then also that's like $12 a month. So it's sucks. But I think like $12 a month every year over 10 years is going to be like $125 versus somebody who's going to see their rent go up $1,000 in that same decade is probably still better off with the purchase. I'm trying to lower my DTI during a purchase. Any tips? Can I only charge item on my wife's credit card so mine shows up no balance? How about going through non-QM? Is that what you're saying? Like a non-QM loan? Does mortgage show up on credit report? Yeah, mortgage definitely shows up on a credit report. So, yeah, I mean, if you're buying in just your name and your wife's not on there, you could put stuff on her credit card and not charge anything on yours, keep your balances at zero. That obviously helps your DTI. But yeah, debt to income is a snapshot in time of what's on your credit. So in those cases where it's like super tight and we've got to like improve DTI, pay this credit card off and show us proof. Pay this thing down to zero and show us proof. And besides getting like a cheaper homeowners insurance and a couple other things, that's like kind of all you can do. Ask your boss for a raise, have a new salary and a new letter. That's not very easy to get done. Is it possible to cash out refinance and still be able to have a lower mortgage with the same 30-year conventional mortgage? Yes, it is. But keep in mind, for whatever reason, like I talk to people and they're like, hey, I went from 3.5 to 2.875, but my mortgage went up. And I'm like, oh, really? What'd you do? Oh, I did a cash out refinance. I pulled out $100,000. We pulled out a freaking $100,000. Of course your mortgage went up. It's possible. And I've definitely seen it, Mark, like in a case where you're 6 years into your old mortgage and you've got a 4.75. If we do a cash out, pull out 40 grand, put you in a 30-year and go down 2.75, your payment's probably less. But in a case where you've got a 3 3/8 and you've been in the mortgage for a year and you're pulling out 100 grand, your payment's probably going to go up, right? And so it's a function of all that. How much cash you're getting, how much rate change, and how long you've been in the current mortgage. Because if you've been in the current mortgage for 9 years and you're doing a 30, then you're also, re-amortizing over 9 more years. So that's going to help your payment go down and kind of offset the cash you're taking out. All right, Jason, any restrictions on a HELOC? I want to cash out refi on multifam. I'm house hacking, but don't want to increase the mortgage payment and have to start coming out of pocket. What are your thoughts? I want to cash out refi on a I don't understand the HELOC and the cash out refi. Are they related? I want to cash out refi on a multifam. I'm house hacking, but don't want to increase the mortgage payment and have to start coming out of pocket. I don't get it, dude. Since you can refi multiple properties at the same time, will it be one rate for all properties or multiple rates for multiple properties? It'll be different rates depending, right? If you're doing refinance on similar stuff, 2 rental properties, the loan to value 60% on both of them, your credit profile is obviously the same. You've got a 780 credit score and whatnot, then that would be similar. But let's say you're doing a cash out on one and that's 75% loan to value. That's going to be one rate because of that's a 75% cash out. And then another one might be a 60% rate and term, or another one might be a cash out, but it's capped at 60%. It's going to be, the rate depends on that specific property and the attributes of that loan. Is it rate and term? Is it cash out? Is it investment property? Is it a primary? Is it a single family? Is it a multi-unit? All that stuff, right? As if you were doing that specific loan on its own. The cash out single family investment property might be 3.625. The rate and term 60% LTV rental property might be 3.375. The cash out 4-unit might be 4%. Just examples, but it's going to be based on the property, the loan to value, and the type. All right, Dan, the property I'm selling is hitting the market on Friday. Any non-obvious advice to get the best offers possible? Um, I think people right now, especially, are, you know, as somebody who's watching like stuff on YouTube and plugged into the market would be a fair assumption, I think, about you, Dan. You're probably not like some of the sellers today who are just have no idea, right? They just know that they see national coverage on the housing market is on fire. There's multiple offers everywhere. And they'll take like one or two pieces of that news and say, oh, every house gets 60 offers. I can expect to list at 400 and sell for 500. So they're unrealistic. They saw their neighbor's house, which is 10x better than theirs, sell for 550. So they're going to try to list theirs at 575 when there's no chance. I mean, the thing would appraise at 5.25. Barring you being out of your mind, like some sellers, if it's priced right and it shows well, those are the two biggest things for your target buyer who, I don't know the property specifically, but if your target buyer is an owner occupant buyer, it being priced correctly and showing well are the two most important things, because I've had feedback on some stuff that hasn't sold, and I've talked to agents like, why did that one not sell? It seemed like it was priced correctly. Like, yeah, it was priced all right, maybe a little bit on the high side, but based on how it shows, meaning one, the pictures are going to drive people there in the first place, right? It gets listed on the realtor websites, and if it's got great pictures, it's more likely to get more people to come by and see it. But once they are there, is it like staged? Is it, in good shape? Some things I know turn off buyers are like a bunch of your stuff there. And, houses that are vacant and that are staged or set up like beautifully are just going to sell at a premium versus something that's lived in, right? Like, you got to tidy up your kid's bed and clean up some toys and shove shit in a corner. Like, all right, here it is. Hope you like it. It's just not going to sell as fast and as high as something that's like nobody's living there. It's staged. It's made to look like really expansive in this area and whatnot. Like, that's my opinion as a mortgage broker who's around a lot of real estate transactions. Not a real estate agent myself, but I see the good, the bad, the ugly. So hopefully that helps. All right, Zeta, one of my favorites. We owe $61,000 and it'll be paid off in 3 years. Should we take out a $61,000 personal loan and pay off the house in full? Who are you going to take the personal loan from? And what type of rate are they going to offer you? My guess is that you've got mortgage debt that's not that expensive, meaning like less than 4%. Even if it was less than 5%, you owe so little that it doesn't necessarily matter. I probably would guess, Zeta, like there's not a lot of advantage in shuffling it around now. Spend all your energy and effort just paying this thing off, and those 3 years will go by fast enough that you'll be paid off and you won't have to mess around with a personal loan to pay it off right now. Maybe it's like, hey, you've got somebody who's like, my money is sitting in these accounts and earning nothing. Like, I'd be happy to lend you 60 grand. You pay me 2%. You're like, okay, cool. Now you pay your mortgage off. You feel really good. It's free and clear. And if you're like me, owing anybody anything just is not a good feeling. So you're going to like go very hard and probably pay them off in 18 months because you just don't want to have any, personal debt that you owe. So maybe in that case, it makes sense, but there's no huge advantage to it where it would be something you would run out and try to do. Eddie True, do all jumbo loans require cash reserves? I think all the ones I've seen do. A lot of lenders are coming out with a lot of more jumbo products. I feel like as the market has, exponentially increased in value, I've seen more and more jumbo lenders come to the market in 2021. offering cool stuff like great 10% down jumbo programs. A lot of these lenders are underwriting them themselves, servicing them themselves, so they can kind of make the rules. When they make the rules, some of them want 12 months of reserves, some of them want 3. I've seen as low as 3 months reserves being required. I'm not sure, to be honest, Eddie, if there are any jumbo loans that don't require reserves, but I would say from a buyer profile, I don't know many people who are buying $1 million house that don't have 3 months of reserves in the bank. And I would highly advise against anybody who wanted to do that, right? Sometimes, every once in a while, some of these loan guidelines make sense. You're like, oh yeah, you're going to take out a mortgage that's $6,500 a month. Like, it's probably a good idea that you have some reserves in the bank. And so I would, I would advise against that. All right, Jason, no problem, man. I appreciate you joining. And I had to scroll up to remember what the heck question we answered, but I promise you, dude, like, I would be shocked. Let me know if you even know of anybody or can find someone who says they transfer something into an LLC and the due on sale clause came up. What's the difference between points and larger down payment? Points is just you're paying an upfront fee, and 1 point equals 1% of the loan amount. So if you have a $400,000 loan and you're paying 1 point, it's $4,000. And so you could take your 10% down payment and pay points, let's call it 1 point, $4,000, to lower the interest rate by a quarter or whatever it is. It's going to vary on every single loan. Now that lowers your rate by a quarter on that 10% down loan. A larger down payment is now you're going to put down 15% or 20%. But on most things, like for your question, if you had a $400,000 loan and you put down that extra $4,000 instead of buying points to have a $396 loan amount, it's going to change the mortgage payment very little. And the rate's going to be the same. Rate is only going to change at the increments like 5%, 10%, 15%, 20%. And really in there, the bigger factor, bigger than the rate change, is the mortgage insurance premium going down. And so hopefully that helps. Kimberly Winkfield. Jeff, do you work with Jeff Collins? Jeff Collins, if I remember correctly, I think he works for a broker down the street in Sacramento. Brokers that I know and like and trust. Let me see. Let me see if it's who I think it is. Then I can say some good things. He works with a group down the street, United Wholesale Lending. Buddies of mine. So another broker. And anytime you do a mortgage loan, you want to work with a mortgage broker. So if you're currently working with Jeff, good. You're working with a mortgage broker, one that you can trust. So he'll get you a great deal. Don't personally work with him though, no. Isn't a conventional DTI ratio limit 49.9? It all depends on the automated underwriting system. If you've got perfect credit and 40% down, maybe the underwriting system gives you a yes answer at 49.9. More and more in 2021, they've been cranking that dial. They've been tightening it a little bit to where, up to 45 isn't even for everybody, right? Some people's got to be below 43, below 42 to get a yes answer. So, yes, you could get an approval up to 49.9, but not always going to get it. And that's where I think there's probably some misinformation or some misunderstanding online. They're like, hey, listen, I've got this much income and I've got this much in debt plus this much mortgage. Like, that's 48%. Good. I'm going to get approved. Not the case. You've got 670 credit score. You've got some derogatory stuff. You've got some missed payments. You've got 3% down. Like all the stuff that goes into that algorithm to say yes or no. No, right? And I can tell you from experience that I want everyone to get approved, but I'll plug in, and I say my team and my processor will plug in something and like, what the heck's going on? I've got a 33% front end and a 38% back end, and it won't get an approve eligible. And it's because, either the credit report got a little bit of hair, or, this person's putting 3% down or 5% down, and the algorithm is just like, it's too much risk. I ain't messing with it. That's what the algorithm says. So, the conventional limit might be that, but that doesn't mean everybody is going to get approval at that. C. Precious, thanks for joining. Who's responsible for coordinating the title insurance and closing, the realtor or the lender? The title insurance is basically done by title. And so you enter into contract, listing agent opens title, and the title insurance is set up by then. Your lender's going to send out disclosures that has all those fees on there, but title is taking care of title stuff. Realtor's taking care of realtor stuff. Lender's taking care of lending stuff. And they all work together in harmony to create a clean, easy experience for you. If there's any sort of question on title insurance or any of that, I would go directly to the title company, and you'll have those contacts because they should be reaching out to you right when you get into contract with statement of information and things they need from you. So yeah, get with them if you have any questions on that. Just go directly to title. Can you go conventional 5% and at any point in time pay down principal to 80 and eliminate PMI? In theory, yes. In practice, you'll probably have to. Some lenders, the number is actually 78%, and I don't know where it came from, but it's on the paperwork. 78% loan to value. My guess is you're going to have to reach out to that lender and say, hey, over here, like we started at a $500,000 balance and now we only owe $385. Please remove mortgage insurance. Like I said, it might not be 80%, it might be 78%, but whatever is written into there. I shot a message to the lender on a personal deal of mine, and I asked him a question on this specific thing. Anyway, it was a personal deal, and you can send the lender questions, right? They've got online resources and online like chat feature or something, and they'll send you back like, here's our policy on PMI removal. Okay, this is a really good question. And so are there conventional loans without PMI less than 20% down? I love answering this question because it's something that people smoke and mirror around a lot. And I'd love to bring some clarity to it and show you the real truth. So here's what I'm going to do. I'm going to bring up the rate sheet. I'm going to show you. You either pay the mortgage insurance or you take a slightly higher rate where the lender buys out the mortgage insurance. It's called lender paid MI. And so, yeah, here's a quick snapshot. Let me see if I can zoom in. Plus, minus. Here's like that 725, 10% down, middle of the road credit. And you've got up here, lender paid MI, meaning no mortgage insurance. This right here, zero mortgage insurance, but the rate is 3.236 with no points. You're going to have the whole rate sheet available where you can go lower, go higher, like we showed earlier. right? Where you can like buy it down for 2 points down to 2.75. But that's an option. Or you've got this option down here where you pay $92 a month and the rate's lower, 3.018. And again, you can buy it down if you'd like, pay half a point to get it to 2.875. There's going to be all these rates available to you. But that's all any of the marketing you see around like less than 20% down, no mortgage insurance. This is exactly what they're talking about. Sure, you take a higher rate, 323, pay no mortgage insurance, never pay mortgage insurance. More often than not, you look at this, and you're like, okay, I'm paying about, what's that, $75 less per month in interest, but $92 there. So it's really only $15 difference. And the con of this higher rate is it's that high rate forever until you refinance. This one, once you get enough equity, this MI drops off, and now your payment is $77 less, right? You just paid $15 more for whatever time you had the MI on there. So it usually doesn't make sense. It sounds real good. And it's like, oh, 10% down, no MI. Greatest product ever. I could sell it to you. It probably doesn't make sense in that scenario. But that's the dream they're selling. D. Gurley. I'm scrolling, trying to. Yeah, no worries, Jason. I get confused easy, man. Trying to compare cash out refi versus HELOC. Intention is to buy second property. If I choose HELOC, can I use it for down payment on second property? For sure. And it's the same for both, right? You can take out cash and do a cash out refinance and then have a fixed payment where you're like, okay, now I'm paying $280 more per month because I did a cash out refinance, took some of this cash. Or you have a HELOC, and there's pros and cons to both. And I think that I actually did a video, cash out refinance versus HELOC. For this specific thing, you want to look at like, what is your game plan for paying that HELOC off? Because the only thing that scares me about HELOCs is the fact that they can be adjustable. And so I'd hate to see you, take out $55K, put a down payment down, buy the property. Oh yeah, we got to put in new floors, some new paint, got to rehab the back deck, spend another 20, 25. You're like, I got this credit line. All of a sudden you got $80,000 on this HELOC. Something changes where, not receiving as much cash flow as you thought, or, job, life changes, and you don't get that thing paid off like you maybe had planned. And 5 years from now, the thing adjusts and it's going up to 6%, 7%. It can get nasty, right? Versus a cash out refinance, the rate, and the payment, and it's got no risk of adjusting, right? So that's part of the downside of the HELOC. All right. I can't read any of the, I think it's, well, I don't know. Somebody could tell me. These look like Chinese symbols? But if it's some other language, I wouldn't know. Either way, just English and Spanish, the only two languages I got. Are there any loan programs that allow you to put 15% down on an investment property, even if you have to pay PMI? Yes, you can do conventional 15% down on an investment property. You can, right? I swear I just talked to somebody about this. Am I going out of my mind? Did this go away? I'm going to check right now. Investment property, 15% down. purchase. I think I'm going crazy, Theo. I think I'm losing my mind. It used to exist for sure. Investment property, single family. Huh. Oh, you know what I was doing? I was doing an owner-occupied duplex. And that I can do 15% down on. For sure, used to be able to do an investment property 15% down. It was there. And now I'm pricing it and it's not there. I don't think so. SFR, 15% down. Again, this is a question I should know. But I'm being honest with you guys. I'm not positive. SFR 15% down investment. It used to be there. Not there anymore. Program adios. All right, we're going to find out. That's why I got to come back next week. It's like a TV show where I got to leave some stuff for next week so that you guys come back and watch again. BK all day. What's up? That was the name of my cornhole team. Me and my wife. Gouget all day. We didn't win the tournament. We had fun. There's some pros there. Was that yesterday? Yeah, yesterday. Hey, Kimberly, it can be eliminated. Different lenders are different, but 78 or 80% loan to value. That's when they will remove it. So extra money towards principal definitely helps. Because you're going to have to pay it down to 78% of that original purchase price. In some cases, some lenders will allow you to get like an automated valuation or a new appraisal to then say, okay, now it's worth X and our loan balance is 78% of X or lower, remove mortgage insurance. But check with your servicer because different ones are going to view it differently. Do all title companies charge the same prices? For the most part, it's so close. And one of my biggest things, Dan, that I wouldn't say it bothers me, but on the loan estimate, it'll say services you can shop for, and it's in the title fees section where people ask me all the time. And they're like, can I shop for this? Depending on where you're at, like maybe you look at it, but you're on the sell side. So you're going to, be opening escrow with a specific title company. I would talk to some agents in the area about who they use, why they use them. For me, like the First American, Chicago, Fidelity, all these different title companies, I've seen fees from all of them. They're so close that I would worry less about saving $75 and more about like this title, like this escrow officer's awesome. I'm going to, put together everything, make sure that the buyers have clear instructions on what they need to do, make sure the sellers always update on things, and a really good experience. Like this is somewhere where I would never like shop for the lowest fees because $75 or $125 or whatever discrepancy you can see is not worth it at all. Because I can tell you 300 plus transactions this year, I see some title companies that are absolutely horrendous and they can make a transaction way more difficult than it needs to be versus other title companies that are dialed in and make it smooth like butter. Good evening, Ivorine. I would like to rent my primary 4-bedroom residence and try to purchase a 2-bedroom residence since I'm now alone. No, you should be fine. I mean, downsizing is a thing, for sure. And so a lender is going to, whenever you're moving from one property to the next, more often than not, they want a letter of explanation. If it makes sense, you're all good. I moved in 2017 and I moved 4 houses down and across the street. And the lender was like, why are you buying a house 4 houses down? And it wasn't like that much better than the house I was in. And so lenders are always trying to figure out, like, is this really your new primary? My first house backed up to the freeway. House I moved to in 2017 was 4 doors away, the underwriter even clapped back. Is that a word? Is that a word for kids these days? Clap back? The underwriter said, like, you're still close to the freeway, like, because they're just looking at a map, right? And I'm like, trust me, bro. My wife can't even hear herself think in the backyard. We're going to move 4 houses away from the freeway. It's going to be a huge upgrade, which it was. New house had a pool, other stuff about it, right? But you just explain it. Say, I lived in 4 bedrooms when I had 2 kids live with me. Now I'm by myself. All I need is 2. I'm downgrading. So yeah, that's easy. Miss Taylor, thank you. I appreciate you. Clap back is still a word. I learned some new slang. I've got a kid who went into 7th grade. I had some friends stay the night. Me and my wife were trying to keep up with the youngsters. I learned the term baddie. I think it's BADDIE. Like if a girl's good looking, or if a girl is got her stuff together, she's a baddie. So I learned that. What else did I learn? I learned all kinds of cool stuff, man. I'm 41, but I'm still hip. Don't you guys worry. I still got it. Anyhow, we're approaching an hour and a half. I still got a hour of sunshine in California before the sun goes down. I'm gonna go jump in the pool. I'm gonna dominate my kiddos in basketball. I appreciate each and every one of you for joining. And every Monday, 6 p.m. Pacific Standard Time, please jump on here, ask questions. I appreciate you guys much more than you appreciate me, or at least it's equal. I learn as much as you guys do. And if you have anything that you have questions on, please, whether it's another YouTube video you leave a comment on, whether it's shooting me a personal email at matt@mattthemortgageguy.com. I'll put that up real quick. Send it there. If you're trying to connect with a mortgage broker out of state, greatmortgagebroker.com. If you want to, how do I copy this link? This is the link to the new course. And let me see if I can find it. I actually sold some of these and I'm waiting. I'm asking for people to give me some feedback. Teachable link. I would be honored and happy and excited if you thought enough of me to purchase this course. And if you did, it's $97. If it sucks, return it. Ask for a refund. If it's good, give me some feedback. If it's missing stuff, let me know that too. I was trying to get the link that I could put in the chat, but I'm having some issues. Link. Come on, link. I should have this somewhere on my desktop, right? Teachable. Mortgage 101. Oh, there we go. All right. So I will leave the link in the comments. Check it out. It would definitely make my day. Whenever I see that, when I see like somebody purchase the course, I'm excited. It's brand new. I think it's only been a week or so, and I've got a few people that have purchased it. I'm asking for feedback. I'm asking for what would you like me to add. Once we've got enough course members, I'm going to try to do a Zoom where we can get together and answer some one-on-one questions in private that aren't, some people don't want to ask stuff over YouTube. So anyway, check that out. Let me answer this question before I jump off. We've got Simmer R. What would be the interest rate to refinance $150K for 8-year term? No cash out investment property. I will do a quick price check for you on that one. Investment property. What's it worth? That's the thing we're missing, is what's it worth and what's your credit score. So I'm going to assume that it is worth $450 and you've got good credit, it's going to be one of those where it's a smaller loan amount. So unless you're really high now, it might just make more sense to get to like paying the thing off quick. It's about 2.75 on that 8-year term, and that's like $1,742 a month, principal and interest. Title, lender, appraisal, probably 3,000-ish is between those costs. So that's, yeah, you said 500K. So it's, yeah. And so that's it. 2.75, $1,742 a month, 8-year term, no points, but between title, appraisal, lender, about $3,000. All right. That's it. I'm jumping off. I appreciate you guys. Until next time, we gonna see.